Welcome to the Deep Dive. We're here to cut through the complexity, break down dense source material, and really give you the critical takeaways. Today, we are diving into the latest financials from Balaji Amines Ltd. They're, a key player in India's specialty chemicals space. So our source material today is their Q1 FY26 unaudited financial results press release and also the auditor's review report that goes with it. And our mission, well, we want to unpack these documents. What really jumps out is this interesting tension. You've got stable revenues, even volume growth. But then profitability metrics are actually, well, slipping compared to last year.
Right.
So what's really going on beneath the surface there, and how are they juggling this kind of mixed picture with some pretty ambitious future plans? That's what we're diving into. Let's get into it. Okay, so kicking things off with the high-level consolidated numbers. This is for the quarter ending June 30th, 2025. Q1 FY26, Balaji Amines reported revenue of 367 crore.
Okay.
EBITDA, that's earnings before interest, taxes, depreciation, and amortization, that stood at 64 crore.
Got it.
And net profit, PT, profit after tax, came in at 37 crore.
Right. And putting those numbers into context is really key here. So while that Q1 FY26 revenue, the 367 crore, it's a little bit up from the previous quarter, Q4 FY25.
Okay, just slightly.
Just slightly, yeah. That was 361 crore, but it's actually down compared to the same quarter last year, Q1 FY25, which was 393 crore.
Down year on year.
Exactly. And maybe even more notably, the EBITDA for this quarter, Q1 FY26 at 64 crore. Well, that's lower than both the previous quarter, Q4 FY25, which was 68 crore, and lower than Q1 last year, which was 74 crore.
Okay.
And it's a similar story with the PT, the profit after tax. 37 crore this quarter is down from 40 crore last quarter and 46 crore in Q1 last year.
So if we look at those shifts, what's that telling us about their margins?
Yeah, the margins are where you really see the pressure.
The EBITDA margin for Q1 FY26 was, what, 17%?
That's right, 17%. And that's down from 19% in both the previous quarter, Q4 FY25, and the same quarter last year, Q1 FY25.
Right, so a 2 percentage point drop there.
And the PET pipe margin also saw a dip.
Yeah, a slight dip. It's 10% in Q1 FY26 compared to 11% last quarter and 12% in Q1 last year.
Okay, that 2 percentage point drop in EBITDA margin, I mean, it might sound small, but for a company this size, what does that usually signify? Is it, pricing pressure, rising costs, maybe a bit of both? What's your take?
That's a really good question. And yeah, for a company like Balaji Amines, even a couple of percentage points on the EBITDA margin, that can translate to a significant hit on the bottom line.
Right.
It often points to a few things. Could be higher raw material costs, sure, maybe higher operating expenses, or like you said, intense pricing pressure, maybe more competition, maybe slower demand, pulling prices down. But the interesting thing is volumes were actually up, which suggests demand is, well, still there.
Yeah, that's the positive trend I wanted to highlight.
Right, so maybe getting those sales meant they had to sacrifice some margin. Or perhaps the mix of products they sold shifted towards lower margin items this quarter.
The company did mention that stable commodity prices helped them out.
Oh, okay.
Which kind of suggests maybe external cost pressures weren't the main villain here. It might be more about market dynamics or, internal efficiency stuff.
Interesting. Okay, so let's talk about those volumes then, because that is a positive trend. Total volumes grew quite nicely, didn't they?
They did, yeah. Reached 27,570 metric tons in Q1 FY26. That's up from 25,871 in Q4 FY25.
So where's that volume growth actually coming from, especially if margins are taking a hit?
Good question. If you break down the Q1 FY26 volumes, amines were 7,573 metric tons.
Okay.
Amines derivatives, 8,108. But specialty chemicals, that segment really led the charge with 11,889 metric tons.
Ah, specialty chemicals. That's noteworthy.
It really is. It suggests they're, making inroads there, expanding their reach or grabbing market share in those specific lines, even if the overall pricing isn't great.
And another thing that stood out, a really crucial indicator of financial health from the source material.
Yeah.
On a standalone basis, Balaji Amines is a zero-debt company.
Yes. That's huge.
It's not just a nice to have, right?
Yeah.
For a company planning these big expansions, we'll talk about, what does being zero debt actually let them do? How does it give them an edge?
Oh, it gives them immense flexibility. Fantastic point. I mean, first off, no debt means no big interest payments eating into cash flow.
Right. Frees up cash.
Exactly. But maybe more importantly, it lets them fund these major new projects and expansions entirely through internal accruals,
Mm-hmm.
basically using their own profits.
Mm-hmm. So they don't need to borrow or raise capital externally.
Precisely. Which insulates them from rising interest rates, makes them less shaky if the economy turns down, and lets them jump on growth opportunities fast without, the cost and hassle of external financing. It really points to strong financial discipline.
And that discipline definitely sets the stage for what they're planning next, because
Mm.
they are certainly not sitting still. Let's talk about the new projects, the expansions.
Yeah, and what's fascinating here is just the scale and the strategic thinking behind these. They've got three key projects happening at their unit for you, all funded internally, like we just said.
Okay, what are they?
First up, dimethyl ether, or DME. That's expected to be commissioned sometime in this fiscal year, 2025-26.
DME application.
Aerosol industry, for one. But also, interestingly, as a potential replacement for LPG liquefied petroleum gas in industrial and commercial use. Cleaner alternative, potentially.
Ah, interesting. Ties into sustainability trends.
Exactly. Then they're building a 5,000 TPA plant that's tons per annum for N-methylmorpholine, NMM. Also slated for commissioning during FY 2025-26.
Okay, and the third one?
The third one's a bit further out, FY 2026-27 commissioning. It's an improved process-based plant for acetonitrile, or ACN.
ACN, right? Used in pharma, agriculture.
Yeah, versatile solvent, very important in those sectors.
And it doesn't stop there, does it? There's also that big expansion plan for their subsidiary, Balaji Specialty Chemicals Ltd.
Oh yeah, this is a really significant move. Shows real ambition. They're proposing a massive investment, 750 crore.
750 crore. Wow.
In a phased manner, yeah. And get this, the project has been granted mega project status by the government of Maharashtra.
Mega project status. What does that imply? Incentives?
Almost certainly. It means they likely qualify for significant government support, tax breaks, maybe other incentives under the package scheme of incentives 2019. It helps de-risk that big investment quite a bit.
Makes sense. And what products are they targeting with this subsidiary expansion?
A whole range. Hydrogen cyanide, HCN, sodium cyanide, and ACN. They'll make both a 30% solution and the 100% solid form.
Okay, key industrial precursors.
Vital ones, yeah. Used everywhere from mining to pharma. And they're also investing in EDTA, that's ethylene diamine tetraacetic acid, and it's disodium salt, EDTA2 now.
UDTA. Chelating agents, right?
Yeah.
Used in detergents, agriculture.
Exactly. Widely used stuff. So they're broadening their portfolio significantly.
What about timelines for these subsidiary projects? Are they on track?
Seems like it. The update says the Unit 1 Brownfield project that's likely expanding an existing site for ED-based products that's progressing well. Expected commissioning is Q1 of FY 2026-27, so first quarter of next fiscal year.
Okay.
And the Unit 2 Greenfield project, the totally new plants for HCN, ACN, EDTA at MIDC Chincoli, that's also apparently moving at a, quote, brisk pace.
Brisk pace. Good to hear.
Yeah. Most critical equipment is apparently already on site, installations happening, aiming for commissioning sometime during the next fiscal year, FY 2026-27.
That is a truly impressive pipeline. A lot of capital going out the door, which makes you wonder, what's the management thinking? Especially with those margins being squeezed right now. What did the MD, Mr. D. Ram Reddy, actually say?
Well, his comments suggest a kind of steady-as-she-goes view, but with an eye on the challenges. He said Q1 FY26 performance was stable.
Double, okay.
Yeah, and he attributed that to their, quote, disciplined working model and those stable commodity prices we mentioned. He does anticipate that EBITDA and PAT margins will expand, eventually, as volume uptake improves and the industry sort of recovers.
But there was a note of caution.
There was, yeah. He mentioned that the current global and domestic situation, the macro environment, it might impact how quickly they can ramp up utilization of all this new expanded capacity.
Filling the new plants might take time.
Exactly. Until, as he put it, basic contribution for their products is achieved. Which sounds like, until revenue covers the variable costs and starts adding to profit.
Makes sense.
He stressed their focus on sustainable progress, the ongoing investments, operational excellence, the usual good stuff. But he also specifically mentioned that some products, like electronic-grade DMC and propylene glycol pharma-grade, they're yet to yield better volumes domestically, even though they feel they have a competitive product. So maybe some market adoption challenges there.
Okay, so the overall outlook from him.
Short-term, stable. Medium to long-term. A balanced, market-driven growth approach. Sounds like cautious optimism, acknowledging strengths, but also the headwinds.
Yeah, that sounds very pragmatic. It's a tricky balance, isn't it, communicating big plans when the market's a bit choppy.
Absolutely.
Speaking of the company,
Mm-hmm.
here's a little detail from the press release background section that, well, definitely made me do a double take. Balaji Amines, founded 1988, leading maker of aliphatic amines, serves pharma, agrochem, standard stuff.
Right.
But did you know they also operate a five-star hotel in Solapur?
A hotel, really?
Yeah, called Balaji Sarovar, managed with the Sarovar Group. I mean, that seems pretty far from specialty chemicals. Does the release say anything about how that fits in, financially or strategically?
Uh-huh. That is unexpected for a chemical company. The press release doesn't really dive deep into the hotel's financials, no.
Hmm.
But, sometimes diversification like that, even if it's small compared to the core business, it can offer a bit of stable revenue, maybe act as a small hedge if the chemical market gets really cyclical.
A hedge, maybe?
Huh?
Or just a long-term asset. Interesting sideline, anyway.
Definitely. And just quickly on the reporting side, the independent auditor's review report, it's from M&M & Co.
Right, the review report, not a full audit.
Exactly. It provides moderate assurance, which is less expensive. But crucially, they stated that nothing came to their attention suggesting any, material misstatement or non-disclosure in these Q1 results.
So basically, the numbers look reliable based on their review.
That's the takeaway, yes. The reporting seems to align with standards.
Okay, so let's try and recap the essence of this deep dive then. Balaji Amines, Q1 FY26 showed some margin compression, no doubt.
Mm-hmm. Definitely pressure there.
But revenue held relatively stable quarter on quarter, and volume growth was actually positive. And that's all backed by a very strong zero-debt standalone financial position.
Which is key for what's next.
Exactly.
Mm.
Because maybe more importantly, they're actively making these pretty significant strategic investments. New projects at Unit 4, that huge expansion for the subsidiary, Balaji Specialty Chemicals.
The one with the mega project status.
Right. They're clearly investing hard for future growth, leveraging that financial strength they've built up.
Which leads us to, I think, a really important question for you, our listener, to ponder.
Right.
When you consider these ambitious investments, new chemicals, huge expansions, that government backing, how do you think these strategic moves might position Balaji Amines, especially against, the broader global and domestic market dynamics we're seeing?
Yeah, what could this mean, not just for them, but maybe for the wider chemical industry in India, especially as the country pushes towards more self-reliance and aims to be more competitive globally?
Lots to think about there. How will these bets pay off in the coming years?
Absolutely. Well, what a dive. Thank you for joining us today. We hope this has given you a clearer, maybe more insightful view of Balaji Amines' recent performance and where they might be headed.
Keep exploring, keep learning.
And we'll catch you on the next deep dive.